Good evening and welcome to this evening's London Shipping Laws Centre seminar on recent cases on marine insurance. This is being brought to you in collaboration with Seven Kings Bench Walk, a set of chambers which has a proud tradition in its involvement in not just insurance but marine insurance matters. And you'll find as we go through the cases this evening that my chambers has had involvement in all of the three cases we'll be discussing, both in terms of counsel teams and also in the PT Adadaya matter as having the judge, Sir Jeremy Cook, sitting in the International Court of Singapore. We have a terrific lineup of speakers, including Jawdat Khurshid, more often known as Jawdat Khurshid KC, speaking about the Quadra matter, Professor Özlem Gürses of King's College London, speaking about the PT Adadaya matter, and Mr. Peter Mellett of Bankserve, speaking about Piraeus and Antares. Chairing tonight's discussion is Lord Mance. Lord Mance was appointed to the House of Lords in 2005, where he spent 4 years as a law lord. He became a Justice of the Supreme Court on its formation in 2009 and was its Deputy President in 2017 to 2018, whereupon he came back to his old chambers, Seven Kings Bench Walk, where he acts as an arbitrator. Much of his work as an arbitrator concerns insurance matters, including a number of very high-profile BI cases. So with that introduction, it's now over to you, Lord Mance.
Thank you very much, Richard. Can I be heard? Good, thank you. You are going to hear about cases which I have to confess I'm not familiar with, and I haven't done a huge amount of homework, but it's my pleasure to introduce each of the speakers. And the first of them, Jawdat Khurshid KC, is very prominent. Must be wearing his Victor's Lord cap. In the first, it seems to be an entirely chambers do. But I'll come back to that. Dodi is very active in the commercial law field, not just insurance and reinsurance, but everything else that we associate it with closely with commercial fraud, energy, natural resources, banking, finance, and so on. And I see that he's engaged in what must be one of the currently biggest pieces of litigation involving the loss of aircraft and engines leased to Russian airlines following the invasion of Ukraine. But you don't want a list of cases from me, nor I think do you want me, because or perhaps Dodi wouldn't want me to read the laudits that he gets, or laudats that he gets, but I will just come back to the case, which I see was entirely chambers do, and very recently off the press. And I can claim a small part in it, because not only was a member of Chambers the president of the court, that is the Chancellor, Sir Julian Flo, but I'm sure he got it right because he was my pupil. But the winner is even more obvious that the decision must be right, because he accompanied me on circuit as a first instance judge, which was a great pleasure. But I see all the there must be some small advertising element to these affairs. But anyway, all the other members of Chambers losers as well. But I don't see actually the principal loser here. I can't imagine why not. But anyway, with that rather inappropriate introduction, let me hand over to you, Dodi.
Well, thank you very much. So good evening, everyone. I've been invited to talk through the recent decision of the Court of Appeal in the Quadra Commodities case. Now, the dispute in that case arose out of what is known as the agro-invest fraud. It was, in effect, common ground between the parties to the dispute that the agro-invest group of companies had obtained grain, corn, and sunflower seeds from local farmers in Ukraine, which the group then stored in a number of elevators owned by the group in the Odessa region of southern Ukraine. And the fraud was perpetrated by the Agro-Invest group pledging or selling the same parcels of goods many times over, and by issuing multiple warehouse receipts for the same parcels of goods to the different buyers. And so some reports suggested that up to 5 or 6 warehouse receipts may have been issued with respect to each parcel of goods in the elevators. So unsurprisingly, therefore, when it came to the point of executing the physical deliveries against the warehouse receipts, it was found that there was not enough to go around. So my clients, Quadra, had purchased 7 cargoes of grain and corn from companies in the Agro-Invest group, and they had paid for those cargoes in full or in part against warehouse receipts issued by 3 elevators owned by the group. There's the Blaski elevator, the Bilgorod elevator, and the Ismail elevator. And not having been able to recover the 7 cargoes from those elevators after the fraud had begun to unravel, Quadra claimed on a marine cargo open policy, of which the defendants were the underwriters. Now, the defendants resisted liability, putting Quadra to proof both of the existence of the goods Quadra had purchased from the Agro-Invest group and also of Quadra's insurable interest in those goods. And at first instance, Mr. Justice Butcher held that Quadra was entitled to an indemnity under the policy in respect to the loss of the cargoes. The judge concluded first, as a matter of fact, that at the time the warehouse receipts for the cargoes were issued, there were goods physically present in the elevators corresponding in quantity and description to the cargoes. So goods were physically present, as a matter of fact. Secondly, the judge concluded that Quadra had an insurable interest in the goods which were physically present in the elevators. And finally, the judge concluded that the goods were physically lost to Quadra as a result of misappropriation, and so they could recover on the policy. Now, an appeal from the judge's finding of fact was dismissed by the Court of Appeal. On the evidence before the judge at first instance, Mr. Justice Butcher, he had been entitled to find that goods corresponding in quantity and description to the cargoes were physically present in the elevators at the time the warehouse receipts were issued. And that finding was important because it distinguished the Quadra Commodities case. Cases such as Engelhardt, in which there had been no physical loss of goods and where there was thus no entitlement to an indemnity under a property policy of insurance. So in the Engelhardt case, it was common ground on the agreed facts. There was no copper was ever shipped. In other words, there was never any cargo of copper ingots. And consequently, there was no cargo to be physically lost or, for that matter, damaged. And it was said by Sir Ross Cranston, something must exist to be physically lost. He said there cannot be a physical loss when nothing existed in the first place. So in that case, what the insured was trying to recover was for a financial loss rather than a property loss. And they couldn't recover on the property policy. Quadra Commodities, by contrast, is a case where goods had existed and where they had been physically lost. And that finding enabled Quadra Commodities to recover on a property policy of insurance. Now, the point of more general interest in the Court of Appeal's decision arises out of its treatment of the defendant insurer's second ground of appeal from the judge's holding that Quadra had an insurable interest in the goods that had been physically present in the elevators. The concept of insurable interest is given some colour by the Marine Insurance Act. Section 5.1 provides that every person has an insurable interest who is interested in a marine adventure. And Section 5.2 provides that a person is so interested where he stands in any legal or equitable relation to the adventure or to any insurable property at risk therein, in consequence of which he may benefit by the safety or due arrival of insurable property, or may be prejudiced by its loss, damage thereto, or by the detention thereof, or may incur liability in respect thereof. Now, that definition in Section 5.2 of the Marine Insurance Act is not an exhaustive one. But what it does do indicate three characteristics, the presence of which will normally be required for there to be an insurable interest. First, the assured may benefit by the safety or due arrival of the insured property or be prejudiced by its loss, damage, or detention, or in respect to which he may incur a liability. So benefit and prejudice is the first indicator. The second, the assured stands in a legal or equitable relation to the adventure or any insurable interest in the adventure. There must be a legal or equitable relation. And thirdly, the benefit, prejudice, or incurring of liability must, in consequence of the legal or equitable relation of the assured, must arise, in consequence of the legal or equitable relation of the assured to the property or to the adventure. So those are the three indicators in Section 5 to the Marine Insurance Act for an insurable interest to exist. If those three characteristics are present, then prima facie, an insured will have an insurable interest in the property. Now, that language in Section 5.2 reflects the approach that had been taken previously by Lord Eldon in the leading case of Lucina and Crawford. In that case, Lord Eldon defined an insurable interest in property as a right in the property or a right derivable out of some contract about the property, which in either case may be lost upon some contingency affecting the possession or enjoyment of the property. So persons who have an interest in the property and who thus have a sufficient insurable interest include any person who has legal ownership of the property, including a co-owner and a person with an undivided interest in a parcel of goods. And it also includes any person who has possession of the property, including constructive possession, as well as a person with a right to possession, at least where that right is accompanied by some economic interest. All those persons have an interest in the property. In addition, persons who have a right derivable out of some contract about the property will also have a sufficient insurable interest in the property. Thus, a buyer to whom risk passes under a contract will have an insurable interest, because in the event of loss or damage, he must nevertheless pay the contract price. And so the whole loss will fall on him. So he has an insurable interest, an interest that can be insured. But what emerges clearly from the Quadra Commodities case is that another category of person who has a right derivable out of a contract about the property and who thus has a sufficient insurable interest in the property is a buyer who pays or part pays the price for the property in question. In upholding the judgment of Mr. Justice Butcher, the Court of Appeal held that the proposition for which the decision of the Supreme Judicial Court of Maine in the US in Cumberland Bone, so the proposition for which that decision had been cited in every edition of McGillivray on insurance law since the first edition in 1912, should now finally be recognized as a principle of English law. So the proposition for which Cumberland Bone has been cited in McGillivray is this: if neither property nor risk has passed, payment or part payment of the price will give the buyer an insurable interest, because if the goods were lost or damaged and the seller was insolvent, the buyer might not be able to recover the money which he had paid for them. So now if you pay for goods under a contract, a purchase contract, or part pay for them, you have a sufficient insurable interest in those goods to be able to insure them. So having regard to the facts of the Quadra Commodities case, Mr. Justice Butcher held that Quadra had an insurable interest in the goods which had been physically present in the Zablaski, Bilgerod, and Ismail elevators, because it had paid the purchase price of those goods in whole or in part against the presentation of the warehouse receipts. And as it happens, the judge also held that Quadra had an immediate right to possession of the goods in the elevators as a matter of Ukrainian law, both under a storage agreement which Quadra had entered into and under the warehouse receipts which had been issued by the elevators. And though it did not matter to the result, Mr. Justice Butcher additionally concluded that Quadra had not acquired a proprietary interest in the cargoes, because the bulks of which the cargoes form part had not been sufficiently identified in the sense required by Section 20A of the Sale of Goods Act 1979. Now, I appreciate there's quite a lot of detail on that slide and maybe too small to read. I'm sure you're familiar with the Sale of Goods Act, but Section 16 says where there is a contract for the sale of unascertained goods, no property in the goods is transferred to the buyer unless the goods are ascertained. And that is subject to Section 20A, which was introduced to address unascertained goods. And Section 20A, subparagraph 2, says where the section applies, then unless the parties agree otherwise, as soon as the conditions specified in subsection 1 are met, or at such later time as the parties may agree, property in an undivided share in the bulk is transferred to the buyer, and the buyer becomes an owner in common of the bulk. And the two conditions to which that refers are that the goods or some of them form part of a bulk which is identified either in the contract or subsequent agreement between the parties, and the buyer has paid the price for some or all of the goods which are the subject of the contract and which form part of the bulk. So it was that test in relation to the first condition, the goods or some part of them form part of a bulk which is identified either in the contract or by subsequent agreement, that Mr. Justice Butcher at first instance found Quadra did not satisfy. And in the Court of Appeal, the defendant insurers took that finding. They argued that that finding, that the bulks of which the cargoes form part had not been sufficiently identified, should have provided the answer not only to the question whether Quadra had a proprietary interest in the cargoes, but also to the question whether Quadra had any insurable interest at all. Put simply, the defendant insurers argued that unless the bulks of which the cargoes form part were identifiable and identified in the sense required by Section 20A of the Sale of Goods Act, then Quadra could have no insurable interest in the cargoes for which it had paid and to which it had an immediate right to possession as a matter of Ukrainian law. This, it was said, was because unless you know what the subject matter of the insurance is, it's not possible for an insurable interest to attach to that subject matter. Now, the Court of Appeal rejected that argument. For an insured to have an insurable interest in unascertained goods, it is not necessary for the bulk of which they form part to be identified in the same sense as required for determining whether or not a buyer has a proprietary interest under Section 20A of the Sale of Goods Act. All that is necessary is for the insured to satisfy the three requirements indicated by Section 5.2 of the Marine Insurance Act. That's the burden, prejudice, liability, legal relation, and one rising as a consequence of the other. Now, there were a number of strands to the Court of Appeal's reasoning. They included first that it was fundamentally unsound and contrary to principle to seek to impose on the concept of insurable interest as between an insured and an insurer a requirement concerned with the passing of a proprietary interest as between a buyer and a seller. And that was especially when the authorities on insurable interest established that an insured can have an insurable interest in goods even absent a proprietary interest. Section 20A had been introduced into the Sale of Goods Act to address a perceived shortcoming in the law relating to the passing of property, not the law of insurable interest. And at the time Section 20A was introduced, commodity traders were having no problems obtaining insurance for goods in bulk, according to the Law Commission. And there was no justification, the Court of Appeal found, for applying an extension to the law in one area in order to effect a restriction on the law in another. The law of insurable interest was already wider and wide enough. The second strand of the Court of Appeal's reasoning is that the defendant insurer's argument was not supported by authority. To the contrary, as the Chancellor observed, Cumberland Bone is a case where the insured goods were not part of an identified bulk. The goods in that case remained on the seller's premises, not separated from the seller's stock, and yet the insured was found to have an insurable interest in those goods. So Cumberland Bone went against the defendant insurers. Moreover, although there may have been a debate as to whether Inglis and Stock is likewise a case where goods were an ascertained part of a bulk, it was nonetheless said to be striking that Lord Blackburn considered that it was not necessary for the goods to be an identified part of a bulk for there to be an insurable interest. And the quote from Lord Blackburn is on the slide. I'm quite unable to perceive why an undivided interest in a parcel of goods on board a ship may not be described as an interest in the goods, just as much as if it were an interest in every portion of the goods. So that was the second strand, the lack of authority for the defendant insurer's argument. And a final strand, as the Chancellor observed, was that the defendant insurer's argument went against the direction of travel of the authorities for some 140 years, all of which urged the court to lean in favour of finding an insurable interest to exist wherever possible. Indeed, in Inglis and Stock, the Master of the Rolls went so far to say it is the duty of a court always to lean in favour of an insurable interest if possible. For it seems to me that after underwriters have received the premium, the objection that there was no insurable interest is often, as nearly as possible, a technical objection, and one which has no real merit, certainly not as between the assured and the insurer. And similar comments have followed in more recent cases, such as Feezy, which is on the screen. Now, one important practical consequence of the Court of Appeal's decision in the Quadra Commodities case is that insurers may find themselves having to pay several indemnities in respect of the same goods in future cases involving commodity fraud, if more than one insured is able to establish an insurable interest in those goods. Contrary to the submission advanced by the defendant insurers, that this was tantamount to converting a property policy into a policy protecting financial loss, the Court of Appeal was satisfied that there could be no principled objection if that were the consequence of the wording of the policies which insurers had issued and for which they had been paid the premium. And I think it'll be interesting to see how insurers respond if they will seek to address the position in the wording of their policies going forwards. And that's pretty much all I wanted to say about the Court of Appeal's decision in Quadra. There's just one final point very, very quickly. It relates to this point. At first instance, Mr. Justice Butcher considered a claim by the insured for damages for an alleged breach by the defendant insurers of the term implied into every contract of insurance pursuant to Section 13A of the Insurance Act. I did have a slide for that, but I don't think it's made it into there. But the implied term is that if the insured makes a claim under a contract, the insurer must pay any sums due in respect of the claim within a reasonable time. Now, two distinct questions arose at first instance. What was a reasonable time within which insurers should have paid? And were there reasonable grounds for disputing the claim? Because that's a defence, or can be a defence. Mr. Justice Butcher concluded in the circumstances of the Quadra Commodities case that a reasonable time was not more than about a year from the notice of loss. And he further concluded on the facts that there were reasonable, albeit mistaken, grounds for disputing the claim. And that although there was some delay in certain aspects of the defendant's investigations of the claim, those features of insurer's handling of the claim still occurred within a reasonable time for payment. And so there was accordingly no breach of the Section 13A implied term, but some guidance there at first instance on Section 13A. So that, as a canter, is a summary of the more important features of the Quadra Commodity case. Happy, of course, to take questions at the end in due course. Thank you.
Thank you very much indeed. Yes, extremely clear, if I may say so. And we look forward to hearing next from Professor Özlem Gürses, who is a professor at law at King's and the author of a number of works on insurance or reinsurance, reinsuring clauses. In 2010, Marine Insurance Law, 3rd edition, 2023, Commercial Risks, 6th edition, forthcoming, as well as other writings on both insurance and reinsurance. She sits on the Presidential Council of International Association of Insurance Law, as well as the BILA Committee, and she frequently presents at conferences internationally as well as nationally, and teaches subjects at higher education institutions here and abroad. In Istanbul? Where? Abroad?
Yes, quite a few different places, yeah.
We look forward very much to hearing you.
Thanks very much. I'm going to talk about a case decided by the International Commercial Court of Singapore in August 2022. The case is, to my knowledge, is the first one so far discussed the Insurance Act 2015 sections 10 and 11. But in addition to that, the case has discussed a number of other marine insurance principles, and I'm going to talk about them one by one. First, the facts, and I'm going to move back to the all those principles again. The issue arose when a single point mooring buoy, SPM, that was operated at the Yetagon gas field, that collided with a tanker and the assured claim for a CTL. So the SPM was moored to the seabed that was connected to a crude oil tanker, the Bratisana. And the idea was that the condensate, the product, was to be first transferred to SPM, from SPM to the Bratisana, and then from the Bratisana to the other ships to be carried away. And from the moment that the SPM was placed there and attached to the Bratisana, then collisions occurred between April and July. But in July, then it came to the point that the assured couldn't ignore it anymore, but they had to carry out some emergency repairs. The emergency repairs, they were carried out in August and September 2018, and then permanent repairs, they were carried out in the following December, but then the Classification Society refused to accept the permanent repairs. And the assured then sought quotes for further permanent repairs, and they exceeded the insured value of the ship, which was $4.7 US. And the assured then carried out further repairs in May, June, and then tendered a notice of abandonment towards the end of May 2019. That was rejected by the insurers, and 2 months later, the assured sold the SPM for about $400,000, and then made a claim against the insurers for the constructive total loss of the SPM and the sui labor expenses. So the issues that the judge discussed to decide the matter that can be listed as discussing warranties, because the policy had a warranty, which the assured breached, as the judge found, and the constructive total loss on the basis of the cost of repair, and claims provisions, because there was a claim notification clause which the assured breached. Notice of abandonment, again, the assured was late to tender. Moreover, the judge decided that the assured withdrew the notice of abandonment anyway, and the sui labor expenses. Let me first show you the warranty. So this policy was against total loss only, and it was a claim for a CTL. And the warranty was in the following words. So the insured equipment is only to be operated by and under the supervision of suitably trained and authorized personnel, suitable precautions and preservation maintenance measures to be adopted when storing, handling, transporting, and operating insured equipment. Now, breach of a warranty was this breach, then the judge found that it was breached because there was no evidence of any training of the crew, and there was no evidence that the crew provided suitable maintenance measures or handling or transporting or operating the insured equipment. There was no evidence that actually they were acting as the diligent, trained crew members they would have been acting. There was a breach of warranty, but then obviously then we need to decide then what's the consequence of the breach of warranty, because the contract on the one hand stated that exclusive jurisdiction clause and choice of law clause in favor of Singapore. And at the same time, the contract had a Marine Insurance Act clause, which says that the Marine Insurance Act 1906, as amended by the Insurance Act 2015, was to apply. And the judge decided that because of the wording of the Marine Insurance Act clause, then the Marine Insurance Act 1906, as amended by the Insurance Act 2015, was to apply. Okay, then if we apply the Insurance Act 2015, Section 10, where the remedy for breach of a warranty is to be found, Section 10 says the cover is suspended from the moment that the assured breaches the warranty until the moment that the assured remedies the warranty, if the breach can be remedied, because not every single breach can be remedied, because if the ship sinks and becomes a total loss, then you can't really remedy it. There's no liability there, subject to Section 11 anyway. Because the assured breached the warranty and the loss occurred after the breach, but before it was remedied, then under Section 10, there is no liability. But the next issue is Section 10 of the Insurance Act 2015 has to be considered together with Section 11. It doesn't mean that Section 11 is definitely going to apply, no, but we need to check whether Section 11 will apply or not to ensure that the remedy under Section 10 is applicable. The first step to read Section 11 is to look at whether the warranty here is the warranty, but in any other cases, it could be conditional, it could be any other risk-related term, whether that term defines the risk as a whole. But what types of term define the risk as a whole? We really don't know. There is no statutory guidance on this. The Law Commission left it to the courts, and the Law Commission gave us 4 examples in the explanatory notes for the Act. So the judge here did not discuss whether this warranty defines risk as a whole or not. After all, the consequence actually would have been the same even if the judge had discussed it, but didn't discuss it. I assume that the judge thought, or I'd speculate that the judge thought that it's clearly a risk mitigating term anyway, not a risk defining term. If it is a risk mitigating term, then we ask the question, okay, the assured breached the warranty and the insurer is not liable under Section 10. Now, can the assured prove that non-compliance with the warranty could not have increased the risk of loss in the way that the risk has occurred? If the assured could prove that, then there is a chance for the assured still claiming against the insured despite the breach. But if the assured cannot prove that, the remedy applies. And the judge, considering the facts, no evidence of any training materials or nothing, and if the actually crew had done what they were supposed to do, then the collisions would have been prevented. There is no prospect of establishing Section 11.3. The insurers are not liable. So that obviously determines the matter, but the judge kept discussing the other matters that I listed before. One thing about Section 11 is, whilst it is now bringing this restriction to the insurer's freedom of, if you like, relying on a clause which allows the insurer to reject liability in principle, that Section 11 leaves claims provisions out of its scope. So if we have a claim provision, a claim notification clause, for instance, claim cooperation clause, claim control clause, if it is breached, we don't really need to discuss Section 11. And here, the claim notification clause was a condition precedent to insurer's liability. Condition precedent to insurer's liability means that if the assured breaches it, the insurers are not liable automatically. There is no liability for the claim that's tainted by the breach. No need to discuss Section 11. The judge didn't discuss that. Straightforward application of the condition precedent to insurer's liability. Then there was constructive total loss claim. Now, obviously, there are a number of circumstances where one can claim for a constructive total loss, which is a total loss of the subject matter insured, but in a way that total loss does not necessarily have to be physically total loss, because you look at it in the business sense, whether it is a total loss. And if the circumstances listed under Section 60 of the Marine Insurance Act 1906, then there's a chance for the assured to claim for a CTL, although it seems like a partial loss. So here the assured relied on the Section 62, subsection I, where the cost of repair exceeds the value of the ship when repaired. Well, the value of the ship when repaired, it is what the Act says, but policies normally amend this, and then they say the cost of repair exceeds the insured value. Again, the judge didn't refer to the policy term, but I guess that the policy provided that insured value, and the judge compared the insured value and the cost of repair. Skirting, whether the cost of skirting to be included or not, that was a really determining issue, because if that was to be included, then there would have been a constructive total loss, otherwise there wouldn't have been. And assessment is objective, because we don't look at whether that assured would have done this or not, but we look at whether objectively a reasonable assured would have done or not. And under the objective assessment, the court decided that the skirting was neither necessary nor reasonable, so cost of repair wouldn't have exceeded the insured value anyway. Notice of abandonment. So notice of abandonment, why do we need that? Because unless it is exempted again under the Marine Insurance Act 1906, if the notice of abandonment either is not tendered or it is late, then the assured cannot claim for a constructive total loss, so can only claim for a partial loss. And we have a number of authorities on this where historical cases as well, that the judges decided that the assured obviously needs to consider this, assess this, a reasonable period of time is required for the assured to assess it. But here, the assured actually missed that reasonable period of time, because the assured had known in December 2018 that the quotes, he received the quotes and then that exceeded the cost of repair, allegedly, as the assured argues, and then tendered the notice of abandonment about 5-6 months later. Towards the end of May, it was too late. No chance of claiming for constructive total loss. In any event, the judge discussed, I think this is an interesting point, and it's not really something that every time you read about notice of abandonment, you obviously read about the timing of it, but whether they should withdraw the notice of abandonment or waived the right to claim for a constructive total loss. It's an interesting point, because the judge found that the assured's conduct after the notice of abandonment was inconsistent with the declaration of leaving the subject matter insured to the insurer. So the assured waived the notice of abandonment in view of the judge anyway. Now, finally, the judge discussed sue and labor. Again, that wasn't the determining issue, because breach of warranty established non-liability anyway. Sue and labor expenses, can you claim the sue and labor expense from the insurers if your contract expressly provides that, and if the conditions of the sue and labor are satisfied, then there's a claim against the insurer. But obviously one also needs to pay attention to the policy limit, because sometimes sue and labor expenses are supplementary, sometimes they are not. And here the assured claimed the sue and labor expenses by including all of those repairs carried out, emergency repairs in July, August, repairs in December, further repairs May, June. And the judge said, well, sue and labor expenses, obviously, you can claim for emergency repairs, because the SPM was listing and about to sink. So then when you incurred expenses to stop that, that's sue and labor. And it was because against total loss, and then the total loss was, the danger was there, and then the expenses were incurred for that purpose. But then after the emergency repairs were carried out, those permanent repairs then do not qualify for sue and labor. In any event, the assured submitted no evidence as to how much the assured spent for repairs, and there was no evidence of the expenditure anyway. And on that basis, the judge rejected that as well. So it's an interesting case, because, as an academic point of view, if I were to study marine insurance, or if I want to revise the subjects that I studied, this is one of those cases that would be good for revision. But the thing is, interestingly, whilst there are obviously many authorities decided these principles, they could have been referred to, but you really see only references to one or two cases, which normally we see more references than that when obviously we read the decisions. In that respect, I think interesting, but also interesting because because of the application of Section 10 and 11 of the Insurance Act 2015. Thanks very much.
Thank you very much again. Peter Mellett is Managing Director of Bankserve Insurance Services Limited and has been involved as a marine broker for 45 years with experience in all types of claims work. He's a fellow of the Chartered Insurance Institute. He's lectured on marine underwriting and was, for 3 years, the Senior Marine Claims Examiner for the CII, Chartered Insurance Institute. And since 1996, he's acted as a specialist in relation to ship finance institutions, with particular emphasis on contingency insurance protection for mortgagees and insurance issues during the workout process. He specializes in assisting with disputed claims under owners' policies and has been involved in over 90 mortgagees' interest insurance claims since 1996, having collected the largest MII claim ever made. Thank you. Yes, Peter.
Okay, can everyone hear me? Great. Okay, so my ears aren't good, and my wife will always complain about that. Okay, I'll talk about our wording and the Zuzu. And thanks, Richard, for the invitation, for sponsoring, organising. I would say all the work that our wording has given 7 kBW. I've never made the Christmas cocktail invitation list. but we can work on that. Right. The Zuzu. Now, this was my brainchild when it first came along. And so I was extremely disappointed in exercise to see the end of it and see the claim end in failure. So just to give some brief details, Zuzu was detained by the Venezuelan authorities. She had too much diesel, too much on board in the way of diesel products, and there were suspicions of smuggling. There was a potential war claim, or maybe a detention caused by the charterer, PDVSA. And like any self-respecting ship owner, he'd not declared his breach voyage to Venezuelan waters. At the time, Venezuela was a breach. The owner hadn't declared that to the underwriters, the Hellenic War Club. Incredibly, visits to Venezuela were free at the time, but it's just inherent to go and try and do something and get away with it. So quite amazing. The bank told me of this, and I said, well, perhaps we can look at an MII claim. And therein was started the seed, and we tried to move it forward. Now, last time I did one of these talks, I got quite lucky. And I got lucky tonight when I was standing around, milling around, eating the crisps, because someone who helped me with this wording and provoked some of the debate, which we can have, actually turned up tonight. And I remembered who triggered and who jogged my imagination about the clause. So the history of the Bankserve wording, read prima facie coverage. Okay, this is important, and we've used this a lot, and hopefully it will give you a flavour of the issues behind the Zuzu and why the Zuzu claim failed. Now, this all started with a claim on a ship called Nikitas Roussos. And the owner was caught red-handed trying to scuttle the vessel. I was called around to the bank's office after a decent lunch, and they said, look, we've got a problem. The salvage tug got here too quickly. They found the crew with everything packed, ready to get off the ship. The salvage crew got on board. They found the pipes, which had been cut. They fixed them. Vessel was towed into port. Now, we want to move the claim forward. Understandably, they'd fallen out with the owner, but we can't allege a cause of loss, because the owner will then blame us for his claim failing. In a moment of lucidity, I said, well, that's easy. You don't need to allege a cause of loss. Advance a salvage claim. That's future peril. You can advance that, get that turned down. I'll collect the MII claim for you. And incredibly, that worked. Now, we got an unrepaired damage claim for the water ingress damage that already occurred. And when the dust was settled, a member of our audience, David Osborne, who I saw earlier, said to me, Peter, there's one problem here. Your wording requires a loss to be prima facie covered by the owner's policies. Now, how can that type of claim, that type of scuttling attempt, where there is no doubt what was going on, be prima facie covered? And when I was working on another claim of a similar nature, I came across Samuel v. Dumas. Scuttling is not an insured peril. So I was thinking, well, can we argue that the ingress of seawater is a peril of the seas? But you can't. I don't think you can. Scuttling is not an insured peril. So, based on these thoughts, we went to our underwriters and we moved the requirement for losses to be prima facie covered by an owner's policies from the preamble of our perils clause into subsection 1.1. Now, and I'd say now, one of our leading underwriters looked at what we'd done and said, right, well, I'm not going to write this business anymore because the cover's far too wide. And that will cover anything the owner or charterer or manager may do wrong. And that got me thinking. And it left clause 1.2 as what we later called standalone cover, which, without a requirement for a prima facie loss, covered any act, error, or omission by the owners, managers, or charterers. If you go back to the Zuzu, effectively, we were going to get 2 bites of the cherry. We've got a detention, which wasn't covered by the Hellenic War Club because the breach voyage had not been declared, a breach of trading limits. So we've got 1. If we have a loss prima facie covered by the war policy, we have a 12-month detainment period, where at the end of that, we will get a deemed constructive total loss. Fantastic. We also have a second bite of the cherry, and this was something we'd used on a lot of occasions with clause 1.2, by saying, right, we have our vessel lost for 12 months because of an act of the owner, manager, or charterer. Someone has put too much cargo on that ship, and we're being accused of smuggling, or there is an investigation. So that's where we started, and we started running the claim. Now, everyone probably knows the outcome, that the claim was lost, but there are various reasons why the claim was lost, and that's what I think is important to examine and to take forward and look at the future for MII cover and what needs to be done, because I still think there is an enormous debate to be had about MII covers which are solely reliant on a loss being prima facie covered by owners' policies. So let's have a look. Why was the Zuzu case lost? Right. Now, I'm not just saying this because Lord Mance is here, but the English courts have a wonderful, wonderful way of getting to the right answer. And they get there through various means. Incredibly fair and incredibly sensible. I have a huge amount of respect for what the English courts do. Now, if you take the claim that was being advanced here, this was a claim by a bank who had, at the start of the loan, 2 ships in a security package to support a loan of $70-odd million. Now, after the Zuzu came out, the vessel was released after about 15 months, detained, I think, August 2015, released October 2016. So we had a year's detention, and notice of abandonment was tendered to the war underwriters shortly before release. But the vessel was out. And the other vessel, was trading nicely, the Marios G, no problem. So if you think about it, the judge was sitting there and he would have, if it was me, I would have been saying, well, what have these people lost? Yeah? If the market value of those two vessels was more than $70 million, would everyone be spending a lot of money litigating this claim in front of me? So there's a practical reason. If you look at it, should I be giving a decision in favor of the bank to pay them money when they've got everything they started with? Is there anything lost? Now, that was the mental side of it, I think, and the background. The next one, okay. So we have a claim under two sections, claim under section 1.1, which requires there to be prima facie cover under the owner's policies. In this case, a war policy was their prima facie cover. And Judge Calver decided that there wasn't. There was a lot of expert evidence from Venezuelan lawyers. On balance, he decided that this was not a detention which would rank to fall to be covered under the Hellenic War Club rules. And as a consequence, we had no prima facie cover under the war policy. And as such, the breach of trading warranty wasn't going to help us. We didn't get past first base on clause 1.1. So that was one of the main reasons. And that's something which, again, has made everyone think about this and the question of prima facie. Now, the next way, we tried in some ways to impute the Hellenic War Club rules into our 1.2 claim as well. But the judge looked at the interest section and how the interest was described and the policy. And the interest was described as the assured. Now, the assured is the bank here. The assured's interest in the owner's policies as assignees and loss payees. And he took that interest description and said, right, that means you only get what the owner would have got. So you get nothing extra in your clause 1.2. So by taking the interest clause, he completely destroyed anything we'd had for some 20 years in clause 1.2, which hadn't required prima facie cover on the owner's policies. And by doing that, he just got rid of the question of what clause 1.2 does. And that's where I think he's wrong. I don't think that's certainly not meant to do that. And you cannot, in my view, have MII cover, which responds correctly, if you don't include scuttling. MII was designed and was born from scuttling cases. And therefore, if you're only covering prima facie losses, one major part of what should be an MII cover disappears. It's just not there. And that was one of the main disappointments about that, the interest clause. And immediately, clause 1.2 was potentially destroyed by that. And the other thing, going back to my practical point, the claim was advanced for, forgive me for saying so, a fanciful figure of $70 million. You know, I tried to explain and say, look, we should be mirroring what the War Club should have paid. The vessel was insured for $44 million on war, plus another $11 million increased value, so 55 in all. Originally, when I was involved in the claim, we advanced it for 55 and gave credit for what the vessel was worth when she came out. So we advanced the $35 million claim. Now, and that's where I thought it would be. Again, if you ask an English judge for too much, he's going to lose interest. And he's going to start thinking, well, why am I doing this? Firstly, they got both ships back. Secondly, the $70 million, no matter how technically correct it may be, is just not right. And let's look at what you're losing and try and put you back there. And if you're asking for twice what you're losing, then you haven't got a hope. And could the Zuzu decision have been avoided? Yes. I mean, underwriters, I won't tell you how much they offered, but there was some sensible offers. But why, I will never know. Those settlement offers and efforts were ignored. The claim, someone was determined to run the claim, unfortunately. And the difficulty going back to the claim amount, any offers which were produced were expressed as a percentage of 70 million, not expressed as a percentage of 35. So if you're coming along and getting something like 30% litigation risk, that's not bad out of 35. If you express the same number as a percentage of 70, you've got a great reason to turn it down. So, you know, I would always take away that it's important to get the amount you're claiming right, because you're not going to generate sympathy if you're asking for too much. And to finish, some takeaways. Immediately, the Zuzu decision came out. We went to our leading underwriter and changed the interest clause on anything which didn't already solely say mortgagee's interest. We changed it immediately to remove any reference to the assured's interest in the owner's policies as assignees and loss payees. So we now, and I think any mortgagee's interest policy needs to just have the interest, the insured interest, simply to read mortgagee's interest. Now, notice of abandonment. One of the big things that came out of the judgment too was that notice of abandonment isn't required on MII claims. Again, I think that's wrong, because I think one opposing solicitor who's not here tonight, but was involved in other claims pretty well running parallel to this. We were running some 1-2 claims on vessels detained in Venezuela. And he said, you haven't tendered notice. And you're only going to get a constructive total loss if the vessels are detained for a year from date of notice. If you haven't got a prima facie loss under the owner's policies, I don't think you can transfer and get the benefit of any deemed total loss provision in the owner's war policy. I don't think you can do it. You can't dip in and say, I want to ignore the fact that I haven't got a loss prima facie covered by the owner's policies, but at the same time, look at the policy and say, well, I like that part because that gives me a deemed total loss after 12 months. So I think if you are having standalone cover and you're trying to rely on clause 1-2 for any act or omission which created a constructive total loss, you should also, to make sure you create that total loss, that constructive total loss, tender notice of abandonment. And we have in subsequent cases where we're using clause 1-2. I think that's important, and I don't think you can rely on the judgment saying you don't need a tender notice on MII claims, because I think that only counts if you're relying on prima facie coverage on the owner's policies. Takeaways continue. Just make sure in MII covers that scuttling and deliberate damage are specific perils, and there is no subjectivity that the loss is caused by a peril that's prima facie covered on owner's policies. And just the last little thought before we break, not all brokers are idiots, and it's worth talking to the people who wrote the wording. Thanks very much.
Right. Well, thank you very much indeed. And congratulations on the timing of all three speakers, which leaves half an hour nearly for contributions or questions from the floor? Keep them fairly short, please.
I don't remember that was discussed in the case, because the insurer would have benefited from what is left of the SPM if the not-so abandonment had been on time. But there are some obviously historical cases where also not so historical. Castor 2, for instance, explains that even if the not-so abandonment had been given, there would have been provided no benefit for the insurers at all. So it's a matter of fact, isn't it, whether one of the exceptions to the not-so abandonment could apply or not. It's a matter of.
Yeah, I've seen various wordings, and prima facie crops up in a lot of them. There's another version which says claims which are recoverable but are not so recoverable because of, and then it lists a number of perils. People do it in various ways. They don't want to. I mean, if you think of it in the other extreme, if you take what we were doing and the literal interpretation of clause 1(2), such as anything that a charterer or an owner does to that ship is covered if that's to the detriment of the mortgagee, then, you know, I've probably not said this very often, and don't quote me on it, but the cover may be too wide. But that's what we have. I mean, we've collected claims on vessels which have been taken by owners and scrapped without the bank receiving the money. And, you know, if you look at that, when does scuttling stop? I mean, and the first time I was asked this question, I went into a bank in Piraeus and the guy was white. And I said, you know, you're right. The first thing Monday morning, he said, no, second ship's just arrived off of a lang. First one's on the beach already. Is this covered? My immediate reaction was no. But then I went to Jonathan Gilman, gave him a free vote, and he said, I think it's covered. I mean, what's the difference between setting fire to something or putting the plug out and selling it to someone who's going to put it on a beach and break it up? So, I mean, the problem is everyone thinks, you know, the scuttling cases, you know, we didn't know. People didn't know what had happened to a ship and it had gone, and they might say, well, you know, you scuttled that, and the owner says no. Well, on the face of it, you got a loss by peril of the sea. And I suspect that's what the simplistic view was. And this may well have come in when the new institute clause, well, the institute clauses were drafted, first set in 1986. Fortunately, I know it's a long time ago. I was young enough not to be involved in that. But the concept of prima facie and there being a loss that is on the face of it recoverable, when it's okay if you got a fire and you breach a warranty, or you breach a CP, as in the case up there, you breach a CP and you got other things, the loss is covered. If you got a fire or collision or something like that, but you can't recover your claim because of a breach of warranty. That works. It's only in cases like this when the owner or charterer has done something and you know what's happened that you've got a problem. It also gets exacerbated if you've got a final court judgment wording, which the institute clauses are effectively, you're always going to get a decision as to whether the claim was covered by owners' policies or not covered by owners' policies before you can go to MII. And so technically, if you have a scuttling and it's proved to be a scuttling, you never get a prima facie loss on those clauses. I mean, my head spins with it sometimes. So yeah. But where it came from, I think it was a simplistic, someone thinking, right, looks like the ship sunk, peril of the seas. On the face of it, that's covered, but we think the vessel was thrown away.
It sounds to me as if, though listening to Peter, some of the changes which take place are quite difficult to follow, but quite important for the market, at least as to their intention. And I mean, I remember cases where it was quite problematic to work out what the background to particular institute clauses was. Does anyone keep a record? Is this closely examined by either the professional or by academics so that people can work out what each different wording was addressing? Because otherwise, in the future, people may have very different ideas. They may, looking back, reconstruct some completely wrong thesis.
Absolutely, that's the problem. And I don't think there is a huge history. I don't think I've tried in the past to get minutes of
the institute
technical clauses committee as to what the thinking is and what the intention is behind coverage, but you can't get it. And if you look at the current institute clauses, 1997 clauses that Charles in the front row and I did a claim on recently, that requires loss prima facie covered, and which should be covered, but for, and then deliberate damage is named as one of the perils. But then you can't, the two are just mutually exclusive, I would have thought. I mean, you can't, if it's prima facie covered, but you know it's done deliberately, you can't have both, I don't think. And interestingly, I had a debate with a lawyer representing underwriters the other night, who was on the other side of one of these claims, and he did agree with me. There is a point to be thrashed out, just not on the particular one we had. That was all. Well, the answer to it, Charles, is we can get the wider cover, but now instead of the prima facie debate, I mean, the easy thing to do, if underwriters don't want a specific peril, is to put an exclusion in. It's so much easier. You keep the cover wide, but then you exclude, and this is what I said to them a couple of years ago, tell me what you don't like, and rather than move prima facie up again and go back to everyone else and what everyone else has, put in the exclusions you don't like. So now we have drugs detention excluded unless there's underlying drugs cover, unless the owner has drugs detention cover, in which case, if that policy doesn't pay, the MII will pay, and that's not a bad way of doing it. And also would suggest that people might want to review their loan covenants to require drugs detention cover, the confiscation of a ship, the owners go out and buy it. And we're looking at that at the moment. And the other exclusion that's come in is any unlawful, unauthorized sale, whether for scrap or otherwise, which takes a vessel out of a bank's control. And those are the two exclusions which have come in. So we've kept it wide, but underwriters have addressed it, and we've got them to address it in a different fashion.
Yes, we've got a question.
What's that? Robert, did you want?
Do you want to?
I'm so sorry. Who was it?
Is someone here?
I'll ask a question.
Yes.
It's for Mr. Khurshid. With the Quadra case having inhabited your mind for some time now, I wondered about insurable interest. Have you come to a view as to whether it really is as nearly as possible a purely technical requirement, or are you convinced that it has some substantive function to play?
I mean, that's probably a lecture in itself. I mean, so one of the judges who's criticised or at least, I don't rephrase that, one of the judges who said that we should strive to find an insurable interest wherever possible is sitting 2 seats to my left when he was a first instance judge in the Capricorn in 1995. But that doesn't answer the question. I think that the heart of the question is, does the concept of insurable interest still have a relevance, or can we dispense with it? And I think there are arguments going both ways. So the first, one of the two traditional rationales for the concept of insurable interest is what's called the anti-wagering rationale. I mean, the concept that insurable interest serves is the dividing line between insurance, which is legitimate, and gaming, which at least at one time was not legitimate. Now, with the Gaming Act of 2005, gaming is legitimate. So you don't really need insurable interest to prevent gambling under the guise of insurance contracts, which was what it was directed at originally. There may still be a reason why it's necessary to distinguish between insurance contracts and gaming contracts, for example, in terms of regulation, the regulation of insurance contracts, what's in, what's out, what's called, what isn't. But you can probably do that otherwise than through the concept of insurable interest. So that first traditional reason probably no longer holds much water. The second traditional rationale for the concept of insurable interest was what's called the moral hazard rationale. So this is that in the absence of an insurable interest, an insured might be tempted to cause the loss simply to claim on the policy of insurance. And again, in that regard, there's sort of been some questions, empirical data saying, well, look, murderers, for example, are still claiming on life insurance policies trying to recover. So is it really a deterrent? Is the insurable interest really a deterrent? But I think you have to take that with a pinch of salt. Just because it doesn't deter all doesn't mean it's not deterring some. And it may still be playing a role. But at the very least, what you can say is that the concept of insurable interest means that the interests of the insured and the insurer are likely to be aligned in the sense that they both would want to protect the subject matter from harm. And so I think there's still a use from that perspective. But there may be other reasons. I mean, I have in mind that the Law Commission, when the Law Commission did the consultation a few years back, the industry, the insurance industry, lent very much towards maintaining, keeping the concept of insurable interest. And there wasn't much desire to get rid of it. And part of that reason, I think, is because it's linked with the identity of the insured can be linked with, for example, who is best placed to discharge the pre-contractual duty of fair presentation. If you have an insurable interest, you're more likely to be able to comply with that than someone who's more remote from the risk. And similarly, the post-contractual duties, for example, mitigating the risk of loss or other post-contractual duties, the closer you are to the subject matter, the more likely you are to be able to discharge that. So I can understand why insurers would like to maintain it. And so perhaps it's not so much, does it have a residual role? It's, if you're looking at reform, the place to look is perhaps whether it would be possible to address the concept of insurable interest at pre-contract rather than waiting until it's raised as a defence later on. So that, I don't know if that's fully answered your question, but those are my thoughts. I think so. And the insurers, I say the insurance market is in favour of and there isn't a strong body of policyholders who are keen to get rid of it. So I think it will stay around unless and until someone comes up with a reason for getting rid of it altogether.
Are you telling us, it interests me, your first the dismissal of the first reason? Are you saying that if we abolish the requirement of insurable interest, the Gaming Act would, how would it kick in? Would it kick in or to prevent the sort of gambling using insurance policies, which took place in a huge volume in the 18th century, I think?
Yes, I mean, it was a pastime of certain sections of society to bet on whether a ship would make it across the Atlantic or whether someone would live for a period of time. And I can see the harm in that, where you've got people effectively gambling under the guise of an insurance. So you're pretending it's an insurance when actually it's a gamble. But my point is more that because gambling is now legal, under the Gaming
I was
Act.
going to say, would it become legal though? I mean, to use insurance, I would have thought there were all sorts of regulatory objections.
You wouldn't need to. The point is, you wouldn't need to use the insurance to gamble. You can just gamble straight. And so the need to dress up a gambling contract as an insurance contract falls away, and therefore the harm it's directed to probably has gone away.
Yes, Richard, and then.
First occasion when we've seen sections 10 and 11 of the Insurance Act come under scrutiny. And that is a significant moment in many ways, because we've all been trying to work out what these sections mean. And I wondered whether anyone on the panel had any views as to whether section 10 and 11 of the Insurance Act is fit for purpose or not. And I just perhaps warn Professor Gürses, because I have a feeling Lord Mance contributed to the arguments on
Can I ask another question then? You dealt with it quite briefly, but you said there was the judge held there was a reasonable time for payment, not more than 1 year. But he then went on to hold, in the way you put it, that there were good grounds for not paying. But how can you state what is a reasonable time for payment? How can you say not more than 1 year? If there are reasonable grounds for disputing liability, which justify you paying at a much later date. Only when they've been sorted out must you pay. So why wasn't the reasonable time for payment until judgment?
Yeah. So under Section 13A of the 2015 Act, you've got to separate those two inquiries. So the first inquiry is the standalone inquiry. What is a reasonable time? Ignoring whether or not you've got a potential defence. So what is a reasonable time to handle a claim and pay?
If it's a good claim.
If it's a good claim.
But by definition, it's a bad claim, or at least the insurer thinks, and ultimately is found to be a bad claim. You ignore that. I'm afraid to say I did have some objections to these, and I gave evidence to a parliamentary committee saying that there were problems these sections would pose, but it seems to be not many problems. Nobody discusses them much.
No, as I say, I think, Mr. Justice Butcher managed to deal with it by, in a sense, answering one question and then going on to consider whether there's a defence. And it was because there was a defence, albeit on mistaken grounds, it was still sufficient to run a mistaken defence, because that was a reasonable reason for not having to pay at that time.
Yes.
Section 10 and 11.
Yes, but I think, did you want Lord Mance to answer as well? So would you like to say anything?
I think I've spoken enough.
Okay.
I'm not even sure what
Briefly, I'm conscious of the time, so if I can explain briefly my personal thoughts on Section 10 and 11. I previously researched on Section, I think it's 54, of the Insurance Contracts Act 1984 in Australia, which is similar to Section 11. And there are some problematic issues there, but the court seemed to have overcome that with their broad interpretation of that section. My first impression was that it's similar to that, but then similar to Section 50, it's also a problematic section, Section 11. I thought, first of all, I think maybe I should start with Section 10. I think suspension of the cover is, in terms of if the objective is to provide a balance between the assured and the insurer, suspension of the cover rather than just terminating the risk as soon as the breach occurs, and asking the assured still pay the premium unless the policy provides pro rata return of the premium. That obviously created, if you could, you could say unjust outcomes for the assured in some cases, especially considering the technicalities of insurance covers. And then suspension of the cover, I think, is, if the objective is to provide a balance, is providing a balance to some extent there. But then Section 11, then I found it quite problematic at the outset that it says the term that defines the risk as a whole is outside of this section. Then what type of terms define the risk as a whole? It took me some years to really thinking that, now I understand it better. But for you, then it may take shorter than that. So, but then it is just I kind of have an idea now what sort of terms might be describing the risk as a whole. For instance, if you say that this carriage is from Texas to a port in Malaysia, that would describe the risk as a whole. Or if you say that this insurance covers this house with a fire alarm only, I think there is an argument there because of the insuring clause's wording. The fire alarm is not a risk mitigating term, but it's a risk describing term. But it is entirely depending on how the insuring clause is drafted. Section 11.3 is obviously the assured has to prove that the loss, the non-compliance with the term could not have increased the risk of loss in the way that the loss has occurred. It's obviously the burden of proof on the assured that would then require what caused the loss, and maybe at least if it is not the proximate loss, but attributable to the loss. And Section 10.2 also mentions about something attributable to what happened during the suspension of the cover, because if the loss occurs after the breach is fixed, but then it is attributable to something happening during the time that they should breach, that the insurers are not liable. I think those key words, when they are clarified, Section 10 and 11 have, I think, room to apply maybe with less controversy than I originally thought that would be.
There's one hand which has been appearing and wanting to speak. So,
yes, with regard to single, the whole issue about whether the assured waive the notice of abandonment is something that would. Can I get rid of this? Something that would on the London market, where underwriters place the insured in the same position as it.
Whether or not it would have actually been discussed in the London market, I think would be a matter of fact. The problem there, I think, is that the assured gave the notice of abandonment, and then the judge said that after the notice of abandonment, they still operated the SPM, they still gained profit out of their operation, and then after that, then they sold it for $400,000, and then there is no evidence of at arm's negotiations carried out at arm's length. Nothing. It's just that they said we sold it for $400,000. But why? You were operating it, and then you now sold it for this almost this scrap value. So. My way of thinking is that all of those obvious facts, they influenced the judgment. But yes, normally I actually thought if I still carried on using whatever is left after I gave the notice of abandonment, which was rejected, is it then waiving the right to claim for a CTL? I don't think there is a strong argument there to say that, just on the basis of using then gaining profit. But then selling it, yeah, it's just making it a bit stronger for the insurers to argue that waiver. It's a matter of fact, isn't it?
Perhaps that's a good time to call a break and thank my fellow contributors and ask you to join me in thanking them for their contributions, and also thank, I suppose, Chambers, but also the London Shipping Law Centre for this collaborative evening.